Hi, it's John Kelly. In this module, we are going to discuss materiality. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Materiality is the first thing we have to determine in an audit. And that's because the next thing we want to do is assess risk of material misstatement. And of course, you can't assess risk of material misstatement without knowing what materiality is first. It's material misstatement. Materiality is a matter for the auditor's professional judgment, and it's based on the auditor's perception of user needs. There are three kinds of materiality that we have to document. Materiality for the financial statements as a whole, sometimes called planning materiality, performance materiality, and a second kind of performance materiality that I'm going to call scope. And all three must be documented. Materiality for the financial statements as a whole, planning materiality. There are a number of benchmarks that auditors use: income before tax, sometimes normalized, revenue, and there are others. And benchmarks that auditors will often use: 5% of income before tax, 1% of revenue for a not-for-profit, for instance. And the auditor can use more or less than that based on judgment. So the auditor might use 10% of income before tax or 2% of revenues or less. Now, performance materiality, and I'm just going to read this. Performance materiality means the amount or amounts set by the auditor at less than materiality for the financial statements as a whole to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality. So, uncorrected and undetected misstatements. Now, undetected misstatements use up materiality. If we've done the audit, it's complete, we found no misstatements. We've got to remember we didn't test everything. So we should assume that we have missed misstatements equal to materiality. Okay, so our undetected misstatements equal materiality, and we have no room left. If we expect uncorrected errors, then we need to deduct those uncorrected errors from materiality, and that gives us performance materiality. Now, because materiality directly affects the amount of testing we have to do, we would prefer that it be as large as possible. And to make performance materiality as large as possible, it would be nice if the client corrected all errors, and then we could do less work. And there are a bunch of other reasons we'd want to do that as well, and we'll talk about those later. Some people set performance materiality arbitrarily by a percentage, 50%, 75% of materiality. And anything that's arbitrary is by definition wrong. It could be too high and wrong, or too low and inefficient. And besides that, professional standards tell us that it's not a simple mechanical calculation, and it needs judgment by the auditor. So it's best to be client-specific, best to correct all errors, and then performance materiality is almost equal to materiality, and best to document that in the audit plan. And by being client-specific, if the client routinely doesn't correct $20,000 worth of errors every year, and materiality would otherwise be $100,000, we will have to set performance materiality at $80,000 or maybe $70,000 to give ourselves some breathing room. Third kind of materiality. If applicable, performance materiality also refers to the amount or amounts set by the auditor at less than the materiality level or levels for particular classes of transactions, account balances, or disclosures. So, for a particular class of transaction, for a disclosure, for an account balance, we might have an even lower level of performance materiality. So number 3, scope. For instance, we might decide to set performance materiality at 0 for related party transactions because of our assessment of the users. And that would probably be best documented on the audit program for related party transactions. Now, materiality at the end of the audit. We've already argued that it would be best if everything were corrected, because then materiality and performance materiality are almost the same. But if everything isn't corrected, there's a bunch of extra work we have to do at the end of the audit. We have to include the uncorrected errors in the representation letter. We have to discuss it with the audit committee or those charged with governance. We have to spend time evaluating and dismissing as immaterial the errors we have found. And probably worse, we're going to have to check if our performance materiality is okay. If planning materiality was $100,000 and performance materiality was $80,000, and we found $40,000 in uncorrected errors, and the client refuses to correct it, well, we haven't done enough work, because performance materiality should have been $60,000 or $50,000. So we might have to go back and do more work. And all of that has to be documented. So all of that is additional work. On top of that, regulators and inspectors clearly expect everything to be corrected. The SEC has written 2 really good staff accounting bulletins about this, 99 and 108. An interesting object lesson in this is waste management. This was a fraud, or considered to be a fraud. You can read about it on the SEC website that I've noted there. The auditor identified what probably were deliberate misstatements made by management that were just below or just above the materiality level, and the client refused to correct them and promised that they would slowly correct it over a series of years. Came out later that what they were trying to do was manage earnings, and you can just guess what happened. It all blew up in the end, and the auditor got in trouble, and the audit firm got in trouble, and the client got in trouble. So a bad idea to have errors that are unadjusted, particularly if there's an indication that they're deliberate. So there are 3 kinds of materiality. We have to document them all. It's best if all errors are corrected, and materiality depends on the exercise of professional judgment. Thanks for listening.